All right, welcome back to my YouTube channel at Illumination of NG. So don't forget to subscribe to the video and also click on the notification bell so that you can be notified whenever I drop a new video. Okay, now, today we're going to look at a question on general borrowings. Okay, so from my previous video, you can go and check and look at the links so that you can have access to the video. We've talked about specific borrowing in regards to IAS 23, which is borrowing costs, okay? And now we're going to look at question on general borrowings. So when we talk about general borrowings, we're talking about those borrowings that are not specific in nature, okay? That is, you have series of loans from different institutions, okay? So in this case, based on IAS 23, we're going to use the weighted average, okay? Weighted average interest method, okay? So let us quickly dive into the question and solve this. So we have this question. Okay, so let me start here. Let me say notes. So we have School No Be Scam Limited had the following loans in issue in 2020. Okay, so when you look at this question very well, okay, 5% bank loan, 30 million naira, 3% debenture loan, 40 million naira. So it means that this company took different loans, okay? So bank loan and debenture loan, okay? So with different interest rates, 5%, 3% debenture loan. So according to IAS 23, we are to use the weighted average cost, weighted average interest method, okay? So let me just quickly write that here. So weighted average okay, method. So equals to total interest. So with this method, that is, we are trying to calculate the interest applicable. Okay, total interest all over the total loan multiplied by 100. So we're going to get the interest applicable. Okay, so let us look at the question. So notes, number one, for the bank loan, like I said in my previous video, the loans are always annually, okay? Bank loan, we have 5% of 30 million, okay? 1 million, 30 million, okay? That will give us, that should be 1,500,000, okay? 1,500,000. Then number two, debenture loan. That should give us 3%. 3% of 40 million. 40 million, okay? So that should give us 1.2 or equals to 1,200,000. So at the end of the day, we have our loan. Our total interest, okay, is 2,700,000. Okay. So the calculated interest, okay, that is payable on this loan is 2,700,000 naira. Now, in line with IAS 23, the borrowing cost to capitalize and that to expense. So how do we go about that? So let us now apply this to the formula that we have here. Okay, we have the weighted average method to determine the cost, that is the interest rate or the interest rate to apply to the loans taken. So we have total interest calculated, that is 2,700,000 divided by total loan, which is so total loan here, the total loan, as you can see here, total loan, let me do that here. Total loan, number three, total loan equals to bank loan, that is 30 million. Then we have debenture, that is 40 million. So total loan is 70 million. It is 70. Okay. So we have 70 million. So multiply by 100. So what would that give us? Let us do the calculation. Use our calculator. So as an accountant, you need to have your calculator by your side, okay, for you to be able to do quick calculations, okay. Now let us do the arithmetic, okay. So 2,700,000 divided by 70 million, okay, multiplied by 100. That will give us 3.857. Okay, let's say 3.86. Approximately 3.86 equals to 3.86%. So this means at the end of the day, the 3.86% is the interest that percentage interest we're going to apply to these loans, okay, that we have here, okay, to the loans being used during the construction period. So the company commenced the construction of the school building on the 1st of January 2020, for which it used its existing borrowings. So 10 million naira expenditure means that the construction started already, okay, at the beginning of the year, okay, and 10 million naira expenditure was used on the 1st of January. So meaning that 10 million naira was used on the 1st, meaning that this particular 10 million naira, we use it from the beginning of the year to the end of the year. Okay, so let us go ahead. Let's go ahead. Okay. So number four. Okay. We thought that we use 10 million naira. The expenditure was used from 1st of January. Okay. So let us look at that. That will be for 12 months. Okay. And from January, 1st of January, okay, to December. That's for 12 months. 12 months, okay. And from June, okay, and 4th of January, 10 million naira was used on the 4th of January, and 20 million naira was used on the 1st of June, from June to December. Let's count that: June, July, August, September, October, November. That's 7 months, okay, close to 7 months. So let's now determine the interest to capitalize, number 5. So borrowing cost to capitalize borrowing cost, okay, which is equals to, so let's do that. So for the first loan, the initial loan interest is 3.86 based on the WAI used, percent to bracket, okay. So the first loan was 10 million multiplied by, so we use it for 12 over 12, okay. So let's close that, plus the second loan was used for 7 months, which is 20 million multiplied by 7 over 12, okay, 7 over 12, okay. So what's the answer? So let us do the calculation. 3.86%, so bracket, this will give us 10 million naira, 10 million naira, plus, this is plus, not multiplication, please, is addition, please, this is addition, okay. So bracket plus, okay. So this addition, we add it together, okay, because those are the two loans that we collected during the period of construction, okay. So let us now 7 over 12, do the calculation. 7 over 12, 7 divided by 12, multiplied by 20 million. 20 million, that will give us 11,667, okay. So that will give us 11 million naira, 66667. So what's the total figure? So let us move on. So let us now finalize. for us to know the amount to capitalize. So 10 million, that's 3.86%. 0.86% into 10 million plus that will give us 21 million 666,667. So let's do that. Let's do the final calculation. So we have 3.86 divided by 100 multiplied by 216666 21667 okay, that'll give us 836333. Okay, that's equals to 836,000 333. So that's the amount to capitalize. So out of the loan that we took, okay, the loan of 2.7, that's a 2.7 million naira interest. We are able on the 70 million naira loan. Okay, so we're going to capitalize 836,333. Okay, so since we are capitalizing 836,333, meaning that the amount to expend, okay, to capture as an expense, okay, that will be expense to be recognized in the income statement, okay, is now because we took a loan of 2,700,000, okay, and we are only able to capitalize 836,333 because we have to pay back the loan. Okay, so this will now be a charge, okay, on the profit in the income statement or statement of profit or loss. So what is the balance? So that will be 2,700,000 minus 8,836,333. Okay, that is 1,863,667. So this will go to the expenses on the income on the income statement, and this will go to the balance sheet. Okay, balance sheet or statement of financial position. Capitalize. That is, we're going to recognize it in the assets. So our asset now, okay, since the value of the asset, the initial loan to build the building is 70 million. Okay, so mean that as our asset, non-current asset. So our non-current asset, okay, under our non-current assets, current asset, we have building, which is the initial loan cost, which is 70 million naira, plus, okay, plus the capitalized interest of 836,333, okay, which will now give us total figure of what? Of 70 million 836,333, okay, as well as the total value. Okay, so the value of the asset, value. So the asset value has now increased because we have capitalized it as 70,836,333. So in the income statement, when we have our profit, say profit brought down from the trading account, we have that here. Okay, we have less expense. So less expense, okay. So we have under expense, we have interest, which we are going to expense, which is this 667. So that's what we're going to expend. Okay, so 1 million So 1,863,667 is what we're